Hello everyone, my name is Vendra Agusta and I am an EMBA student at IPMI International Business School. In this video, I want to share what I've learned about corporate finance. This course has been an eye-opening experience for me and is taught by the amazing Prof. Sembel. Prof. Roy not only shared his vast knowledge of finance but also encouraged us to embrace mistakes and learn from them. He emphasized the importance of learning by doing rather than just passively listening, which has been incredibly insightful and transformative for me. Now, let's dive into the main subject, what I've learned in corporate finance class. Prof. Roy explained that there are 8 key topics in financial management: introduction to financial management, time value of money, capital budgeting, analysis of securities, capital structure, corporate restructuring, fraud risk management, and lastly, dividend policy. I'll start with the first topic, the introduction. This section will be the most detailed, as not everyone in the class has a background in finance. The first one is the objective. Why should you learn about financial management? Well, there are many reasons, but the most important one is to gain problem-solving skills in finance, whether as a company's management or as an investor. Next is the definition. What is financial management? It is the optimal orchestration of internal and external financial resources towards significant and sustainable value creation. Then comes the goal. Essentially, there are 3 main goals of financial management: basic, operational, social, and research. However, the general goal is to create significant and sustainable value for the company. But what is it needs to be managed? Well, there are capital structure, working capital management, asset structure, revenue management, cost management, cash flow management, growth management, and lastly, risk management. Next, we learn about the goal of the firm. This goal is essentially aligned with the goal of financial management, that is, creating significant and sustainable value. However, we also discuss a common issue called the principal-agent problem. This problem arises when the goals of the shareholders, aka principals, are not aligned with the goals of the management, aka agents. Managers might not always act in ways that maximize shareholder wealth. While no ideal or flawless solution exists for this issue, there are strategies to mitigate and lessen its impact, such as make managers' compensation reflect share prices, stock options, fire managers who do not perform well, corporate takeover, and lastly, GCG. Among the solutions, let's talk more about GCG, also known as good corporate governance. Where does the concept of GCG come from? Madura? Well, actually, it's an accumulation of practices from countries worldwide. In Indonesia, the implementation of GCG follows the concept of TARIF, TARIF, which stands for transparency, accountability, responsibility, independence, and fairness. For the last 2 parts, we learn about McKinsey's 4 cornerstones of corporate finance and Prof. Ramcharan's 5 business essentials. According to McKinsey, the 4 cornerstones are core of value principle, conservation of value principle, expectation treadmill principle, best owner principle. All in all, those 4 are parts of the value creation. And according to Prof. Ramcharan, the essentials are cash, ensure steady cash flow to fund operations and growth; margins, improve profitability by managing costs and increasing efficiency; speed, act quickly to turn ideas into results and stay competitive; customer value, deliver what customers need and exceed their expectations; and lastly, growth, expand through innovation, new markets, and scaling operations. And that's all about the introduction. Next, we'll learn about time value of money. By definitions, it states that money available today is worth more than the same amount in the future due to its earning potential. Its application can be for mortgage and car loan payments, life insurance, personal financial planning, time deposit, contract values, damage in court cases, investment values, capital budgeting, and lastly, company values. TVM consists of compounding and discounting. Compounding is the process of calculating the future value of money by adding interest or returns over multiple periods, while discounting is the process of calculating the present value of money that will be received or paid in the future. We also learn about Rule of 72. The Rule of 72 is a simple and quick way to estimate how long it will take for an investment to double in value based on a fixed annual rate of return. After that, we learn about capital budgeting. Capital budgeting is a process used by businesses to evaluate potential major projects or investments. It involves analyzing the expected cash inflows and outflows associated with a project over its lifetime to determine whether the potential return justify the initial investment. The purpose of capital budgeting is to estimate the expected future cash flows, to evaluate the project based on capital budgeting evaluation criteria, and then to decide whether or which project is good or bad. There are four methods of capital budgeting, that is, payback periods, which calculates the time it takes for a project to recover its initial investment. Net present value, which calculates the present value of all expected future cash flows, discounted to their present value. If NPV is above zero, then the project is acceptable. Profitability index, which measures the ratio of the present value of future cash inflows to the initial investment. If PI is bigger than 1, accept. If it is less than 1, you should reject the project. Internal rate of return, which determines the discount rate at which the net present value of a project becomes zero. If the IRR is bigger than the required rate of return, accept. But if the IRR is less than the required rate of return, reject. Next, we learn about analysis of securities. On this topic, we learned that there are two types of investment strategies, that is passive and active. For the passive strategy, you can just follow the market. But for the active strategy, you need to learn about the fundamental analysis, technical analysis, and the market or investors' sentiment. We also learn about the types of financial ratios. There are profitability ratio, which consists of return ratio and margin ratio. Liquidity ratio, which consists of current ratio and quick ratio. Activity ratio, which consists of turnover ratio. Leverage ratio, which consists of debt to asset ratio and debt to equity ratio. And lastly, market ratio, which consists of earning ratio. There are also other important tools, that is CAPM and WACC. CAPM, or the Capital Asset Pricing Model, is a financial model that describes the relationships between systematic risk and expected return for assets, particularly stock. CAPM suggests that the expected return of an investment is directly proportional to its systematic risk. And WACC, or weighted average cost of capital, is the minimum return that a company must earn on its investments to satisfy its investors. It's used as a discount rate in several key financial analyses, most notably in the discounted cash flow method for valuating a business. And then we learn about capital structure. By definition, capital structure is the way a company finances its overall operations and growth through a combination of debt and equity. Capital structure is supported by a theory that says benefit of debt financing is that interest is tax deductible, whereas payments to equity providers are not. However, firms must trade off this benefit against increased financial risk associated with high debt ratio. In the real world, capital structure is when the firm attempts to balance the cost and benefit of debt to reach the optimal mix that maximizes the value of the firm. There are two factors that determine the optimal capital structure, which is tax benefits and cost of financial distress. Next, we learn about corporate restructuring. Corporate restructuring refers to the process of reorganizing a company's structure, operations, or financial setup to improve. The goal of corporate restructuring is to enhance the company's efficiency, profitability, and long-term viability. For a declining business to survive and transform, there are things that should be done. 1. Stop the bleeding. 2. Do a financial restructuring. 3. Temporary pivoting. 4. Strategic realigning. 5. Redefining core business. And 6. Lastly, research for new ways of doing business. Then after that, we also learn about fraud risk management. There are three types of fraud commonly found, that is, corruption usually includes conflicts of interest, bribery, illegal gratuities, and economic extortion. Next, asset misappropriations, for example, cash, inventory, and all other assets misappropriations. And last, a fraudulent statement, which can be financial or non-financial. The reasons for frauds are many, but mainly because of personal debt, lifestyle, over-speculation, gambling, unfair treatment, pressure, substance addictions, and affair. There are some ways to prevent frauds, which are build employee ethics, create SOPs, train employees for alertness and dangers of fraud, protective security, and lastly, whistleblower mechanism. Lastly, we'll learn about dividend policy. Why should a public company pay dividend for its investors? Whereas by improving their market value, the investors will gain bigger benefits. Well, there are two reasons for that. That is, 1. Tax, since dividend got taxed less. 2. To prevent the company from having too much cash, as having too much cash around will increase the chance of the principal agent problem to happen. And 3. To prove the company's strength. And that concludes the overview of what we've learned in Prof. Roy's corporate finance class. While there are many other valuable insights that might not be covered in this video, I believe this provides a solid summary of the key topics. Thank you for watching, and I hope you found this overview helpful. See you!